thank everybody for appearing today. And we've got 42 total registered. And I think right now we're about halfway there. We have 17 states represented in today's call, 3 different countries, the US, the UK, and Canada. And with that, we also have a nice cohort that joined us today from the retailing group. We have 16 individuals registered, and then a total of 20 for the transportation and logistics special industry group. And then there were 6 individuals who are registered for both. Today's topic is the 3PL trends, inflation factors, and retail logistics. And with us today and presenting is Andrew Cox. And Andrew is let me get this right here, the Senior Retail and Market Analyst for FreightWaves. And you guys haven't checked out FreightWaves. They've got a lot of good statistics, definitely a disruptor in this industry, providing a lot of good insight. So I would suggest you definitely, after this, I would say this presentation, check them out, register for some of the information they're providing. And then with that, also maybe connect with Andrew, and especially if you're in the retailing SIG or transportation logistics, definitely some great things he's delivering. Twice a week, he is penning the supply chain newsletter, which is called Point of Sale, and then also hosting a show that's bearing the same name, and then also has a freight podcast, Great Quarter Guys, and I believe that's on Tuesdays at 3 p.m. As far as the agenda today, we're going to go through the presentation by Andrew. From there, we will have some time at the end for some Q&A, but please, during the discussion, use the chat box and go ahead and record any questions that you have. Mike and I will try to do our best to interject questions throughout the session, and then there will be some time again at the end to ask questions of Andrew directly. We will, hopefully at the end, if we have enough time, have a networking opportunity between 6:15 and 6:45-ish. We'll see how that goes. And what else? Oh, just a reminder, there's 3 ways you can help to support the thing. One is through, your, charitable contribution to the organization itself, inviting new members. And third, definitely as you pay it forward in support of those that are currently in transition. And my last note before I turn it over to Andrew, basically our next call will be Monday, June the 21st, topic to be determined. And I do have to give Mike all the credit for this one. He set this up and basically connected us with Andrew. So with that, Andrew, I'll turn it over to you.
All right. Thank you so much, James. And thanks everybody for, tuning into this, and thanks for the opportunity to introduce you to a little bit of Sonar data. If you haven't seen it before, Sonar is FreightWaves, analytics and freight forecasting platform. It's very powerful, and it has a lot of use cases outside of freight, but freight, by none right now is, the best place to use it. And I'll show you why some of that data. So here is kind of just the overview that we've got. So I'll go through a current state of freight. So talk about some supply and demand dynamics, what that's doing to prices, not only on over the transportation, over the road transportation, but also on the seas and intermodal and air freight. I mean, transportation costs are rising in every direction that you look. We'll talk a little bit about where we are in the cycle. I have a great chart from Echo that was on an investor presentation a few years back that simplifies it, but gives us a good framework to work through and where we are. And then, we'll discuss through some of the trends in retail that are affecting retail supply chains. Okay, so number one in this state of freight is just we have this exorbitant freight demand, and it's not going anywhere, and it hasn't gone anywhere for about 9 months now, since Labor Day. It's been this kind of crazy demand. So if you haven't seen this chart, this is one of FreightWaves' kind of breadwinning homegrown indices. So this is the outbound tender volume index. So this is a measure of freight demand. What happens is we have many partners that we have anonymized data from. We get when a load gets created and it goes to get tendered electronically to either a broker or to a carrier, it is recorded here. We have it indexed to starting at 10,000 on March 2018. So the blue line here is 2021, but I don't really want to start there. I want to start at the bottom here with those purple and orange lines. Those are 2019 and 2018 respectively. Those are our baseline here. That is what the freight market looked like. That's what a normal freight market looked like pre-pandemic, pre-Americans stuck in their homes without any services to spend our money on, and reverting to much more goods spending. And we'll talk about that throughout. The durable goods demand that has gone on throughout the pandemic and has continued into 2021 is remarkable, and it's pushing freight volumes. So I will take a look at 2020 because I think it's important to just look back at the year. So that is the green line. Again, we started off the year in a completely normal fashion there in January and February. And then if you think back to March and April of last year, if you can recall that time, that is when the lockdowns first began. We were dealing with the onset of the pandemic. People went crazy at the supermarket buying paper towels and toilet paper. The stockouts began there in the personal care and toilet paper and paper towels, but quickly went to pasta and beans, and there were chicken breast shortages for a long time. So it just spilled over everywhere. But as fast as the demand came, it was gone, because there in April and May, not only did consumer demand wind down for everything except for groceries, we also had the entire country that was shut down. You had 63% of retail openings or retail doors were closed during April of last year. So freight demand slowed, the economy slowed, but it picked up much quicker, at least on the consumer side and on the freight side of things. We had, there after the 4th of July, you had consumers with $1,200 of stimulus in their hands, no service spending, being locked down, a very high savings rate, and you had the warming weather. Everything was kind of bubbly back then in between waves, and consumer demand kind of ripped there, and that green line, just was on this torrid growth up into where it is now in this 15,000 range, where the actual number isn't all that important in this instance. It's really just about the direction and the overall level that it's been at. So freight demand on the transportation side has been incredible. It's been driven by import volumes, and we'll get through into some of this as well, but it's been driven by import volumes and driven by consumer demand, and extreme housing demand is also a big volume pusher here. So that's just kind of a look. If you guys have any questions, just hop in, but that's just kind of an overall look at freight demand. The outbound tender volume index, it's up, on a non-adjusted basis, it's up, 50% over what we would consider a normal time, and 10,000 being a pretty normal freight environment. So volumes are very strong. So looking at capacity for a moment. So this is another homegrown index. This is the outbound tender reject index. So as those tenders are created and sent to carriers or to brokers, they are either accepted or rejected at the contracted rate. So this is just a measure of relative capacity, right? So right now in that blue line, you have it saying it's at 24 or 25%, meaning that 25% of all electronically tendered loads are being rejected at contract rates right now. That would indicate that shippers are having a difficult time getting their loads covered, meaning 1 in 4 loads is being rejected right now. That is an extremely high rate. It's more or less the natural ceiling. We see it go to 28% sometimes, but 25, 28%, it's not much difference there. It's very, very tight capacity and difficult to get loads covered. That orange line at the bottom, that's 2019. And that would be considered a loose environment, but not a historically terrible environment. It was a very loose time. We would think maybe in the 5 to 8% range is a normal rate. So you're getting into double digits. You're getting into what we would consider a carrier's market, where they have the upper hand in rate negotiations. You would see in that time, you'd see rising spot rates and likely rising contract rates if it holds for an extended period of time. So in 2020, that green line, remembering back to that surge that I was speaking of in March and April, where consumers were hoarding goods, we had a 30% increase in tender volumes in the course of just 3 weeks. That flooded transportation providers. You saw the outbound tender reject index fly up from 5 to 20 in a matter of 2 weeks. Carriers were rapidly rejecting freight because they knew they could go to the spot market and get higher rates because people were grocery and home improvement at the time, but mostly grocery and CPG they were paying anything to get this freight moved because the consumer demand was unbridled at the time. And then again, fell off as quickly as it came. Freight markets came to a halt. The outbound tender reject index fell to 3%, meaning basically every load in the country was getting covered at that time because carriers were taking whatever freight they could get. But that quickly changed as the summer months came. Freight demand became very strong, and you had a meaningful portion of capacity taken offline in those early months of the year for a couple of reasons. One, you had the Drug and Alcohol Clearinghouse. This is a new safety measure that's been passed that calls for random drug tests and stricter drug and alcohol tests that put people in a clearinghouse if they fail. This has taken tens of thousands of drivers off the market. And you also had a bevy of early retirements as carriers were looking to wind down balance sheets and wind down their costs. They've kind of gave some early severances to people and asked people to retire. So that took some capacity off the market as well. And this is, as you all know, freight is an extremely competitive market. So just small changes in either demand or supply can have big impacts. And so at the time, the summer month came, demand came back and snapped back pretty quick. Capacity was a very tight market and has stayed very tight since September there. I guess you can see my arrow here. Labor Day weekend, it has stayed above 20% pretty much for the entirety for the last 6 months. So transportation capacity very tight. What does that lead to when you have high demand and low supply? You have significant spot and contract rate inflation. So we're going to talk about a couple inflationary factors that we're seeing trickle down into consumers. This is certainly one. It is transportation costs, and as I'll show you, it's not just over the road transportation. It's maritime transportation. It's air. It's intermodal. It's pretty much everywhere you look. So the blue line here is the truckstop.com 7-day dry van rate per mile. So this is inclusive of fuel. That's where you're seeing this difference here. The blue line, again, inclusive of fuel, so near an all-time high. It's above $3 per mile, $3.20 per mile. That's more than 50% where it was pre-pandemic, and more than double off the bottom there in April. And the same has gone for contract rates. So spot rates lead contract rates, and this contract rates, the VC RPM1, that is the orange line there. That is a FreightWaves index that we create using real data, a very robust data set of tenders from across many different segments and sectors, and those have risen. It is at an all-time high as well, $2.50. That is exclusive of fuel surcharges. So very significant spot and contract rate inflation, and we can talk about what I think is going to happen or where we are in the cycle here in a moment, but just very high cost there. And the same story goes on the seas in an even bigger extent. So this is the FreightToast Daily Baltic Index. So the blue line is China to the U.S. North American West Coast, and the green line is China to the North American East Coast. So typically the travel, going to the East Coast is more expensive. It's a longer haul going through the Suez Canal. And so it's usually more expensive. So, but both just incredible inflation over the past year, up 4x where it was pre-pandemic. And this doesn't even get you on the boat, guys. This is just a spot. This is just a spot rate. You still have thousands and thousands of dollars in surcharges and excess fees that are piled on top of these. His name is Neregis Poskis from Flexport. He is fantastic. If you just Google him, Poskis, Poskus, and type in FreightWaves, he's on talking to our people all the time, and he's seeing $15,000, $19,000 that they're willing to offer to get a container from China to the West Coast, and they simply can't find capacity. Like money, at some point, money is not even an option at this point. Capacity is so tight that there's just simply no space on the ships, and it doesn't matter what they're willing to pay in some instances. That's the type of market that the freight forwarders are dealing with right now. And again, and if you want to look out at imports coming in, I don't think I have the import data with me here, but our import data, our import expectations, they're rising over the next 4 months. If you look at the global port tracker from the National Retail Federation and Hackett Associates, they are projecting record levels of retail imports and import volumes over the next 3 months. And every time that I talk to Daniel Hackett, they're increasing their monthly expectations seemingly every month. When they refresh, they're going even higher. So the demand's not going anywhere. And I will say, this is my least area of expertise is intermodal. I just wanted to give you one little snapshot to show you that the costs on the rails and on intermodal are rising as well, because CPG companies and other types of companies that move low value goods and are not as on, such a time crunch, have looked to the rails as an opportunity for cost savings with these extremely tight transportation markets. So you're seeing rising demand there and rising costs. Again, we're lapping the 1 year right here. So you're looking at, compared to some of the early months of 2021 when rates fell significantly, but just directionally here, intermodal rates are rising as well. Okay, so this is a fantastic chart that we've used just kind of as a simple framework to think through freight cycles. So of course, not every freight cycle is the same, and this one has been very wacky on both ways, but again, just kind of a simple way to think about it. If in 2018, as I was speaking, that was kind of the last time we had, well, I guess I didn't say this actually, but 2018 was kind of the last time where we considered a freight bull market, early 2018. Freight rates were high, demand was strong, but capacity quickly entered the market as it does in cyclical industries. It quickly entered the market, squashed rates, and there in 2019, this is going into 2019, you had a time where you had very low rates, you had very low tender rejection rates, so you had loose capacity, you had more supply than demand. You can think about these two lines in multiple ways. You can think about it as freight supply and demand. You can also think about them as contract and spot rates being more volatile than contract rates kind of following them at a lag rather. And then see what happened at the beginning of 2020 is, let's say we were coming out in a place of recovery, but we had demand come back quicker than expected off the rebound, driven by consumers, driven by government stimulus, and you also had a meaningful portion of capacity that had been taken off the market in the first 4 or 5 months of the year, and you had really tight bottlenecks at the driver training schools. I had read a study by Jeffries that said that I think that the nation's driver training schools were running at 59%, pretty much all 59% of pre-pandemic capacity. So you had 100,000 fewer commercial driver license issuances last year than normal, and you pair that with the drug and alcohol clearinghouse, and simply, some of the fact that some of the drivers didn't want to risk themselves getting sick. That also kept some drivers off the road, and they took advantage of the unemployment insurance that was oftentimes, could have been more than what they were getting paid. So all of these catalysts have kept drivers off the road, but as I said, demand has rebounded very quickly, and we are seeing some signs that there are some signs that we could see some capacity entering the market. Some analysts are calling for a second half 2021 kind of slow down, a moderation in demand, and some added to supply. A lot of that belief is driven by the really high equipment orders that we saw in the back half of the year and the beginning of this year. But all of those, many of the bottlenecks that I spoke about earlier at the driver training schools remain. And if you look at the wage inflation that you're seeing across the board by the carriers, very, very high rate of, like, some of the biggest wage inflation you've seen in recent years. They're doing that because they're having a trouble keeping their trucks seated, and they want to keep their good drivers here, within their building. So they're paying up to make sure they have them. That's a sign that the drivers are hard to come by, even if you can buy all the equipment you want, but the drivers right now are hard to come by. So where we are now, we're at a point, I would say that we're here in this point now where we're coming up on a peak, but we've been coming up on this peak for about 6 months now. So this is, I think the slope is flattening, and we could stay at this level for some time throughout 2021. And what I mean by that point is elevated spot rates, elevated contract rates, really tight capacity on both over the road and on the ocean. And it's just going to take some time for enough capacity to be added for this to really turn. Yeah. So if you have any questions, that is kind of a complicated chart. I didn't know if you guys want to pop in.
I didn't see any questions as of yet, but definitely historically, I understand this driver shortage issue, but it's good to see and hear that from an equipment entering the market or being, acquired. Now, hopefully the drivers will follow. So
I have a question.
Go ahead, Hal.
Um, Andrew, you had said that there were a lot of offerings of early retirement. What would early retirement have to do with, how would that impact capacity? I'm a little confused by that.
Also, early driver retirement. So at that time, they were trying to
Early
get drivers.
driver retirement.
Yes.
Oh, I'm thinking more shipping.
No, so yeah, on the transportation side, the actual drivers, there was a lot of incentives given out at that time just to really get them off the road and kind of wane in their costs, because they were seeing freight just dissipate everywhere they looked.
Okay, I was on the wrong boat. Thanks.
No problem. Okay. And so I didn't bring any charts here because I could have gone on, I could have given 2 hours of charts on these trends. So I'd rather we just discuss them. I thought it might be better there. But some of the trends here, and there's more that we can discuss throughout, but transportation cost inflation, as I said, and as I showed, every mode, and it's kind of unabating. We see it, I think the earliest calls for, some of this moderation is in second half 2021. That's what I've seen. But even some of those people that I've seen calling for second half 2021 moderation, as this goes on longer and longer, and as the durable goods demand, that's something one of the consumer trends that's really important right now is, we've seen this reversion from services to goods spending throughout the pandemic as people got locked in their homes and they started buying things for their homes, furniture, desks. They started buying way more groceries, stopped eating out. Usually, I think GDP, 70% of it is consumers, 2/3 of that is service spending in a typical year. I think that slid from 2/3 to 60-40, and that's the type of difference that we're seeing. It's, when we're talking about consumer demand, we're talking trillions of dollars here. Mm-hmm. So that type of meaningful difference. So the million-dollar question everybody is trying to answer right now is, when will that reversion back to services occur? And I have tracked this on a literal daily basis for the last 6 months. And what I can tell you is that I think it's going to happen so gradually that we're going to get sick and tired of talking about it and reporting on it, because the savings rate is so high right now, and consumers have so much money stacked up and saved up from stimulus and from not spending on services for the past year, that we can continue spending on durable goods at a really high clip while also recovering in the services. So the Bank of America's consumer spending data, it's the best data that I can find, and they update it weekly. You can find it for free. Durable goods demand and services demand has remained stable for about the last 6 weeks. And that is remarkable, given that we're seeing reopening across the southern states, even some of the northern states. People are getting out and about, spending much more on airlines, much more on lodging than we were just a couple months ago. So to see them continue to spend a lot on durable goods, that's really good for freight markets and good for the overall economy, I think, just broad-based recovery. And you're also seeing stable mix between Florida and California, two of the biggest economies, but two at vastly different rates of reopening. Florida's been wide open for months. California's just now getting there. You're still seeing really strong durable goods demand in Florida. So I think those are really good things. So I don't know when that reversion is going to be. I think that goods demand can stay strong throughout the year and into 2022. And that's one of those reasons that, I think that the spot rates can continue staying high. Demand for freight is going to stay high. And one other note is that even if that reversion happens quicker than I anticipated and more severely than I anticipated, the freight market is insulated from a lot of this recovery volatility because of the current inventory rates, the inventory levels. I don't know if you guys saw, sorry, I've got dry mouth. I don't know if you saw the inventory levels in March, but in January, I think we're at 1.26 inventory to sales. We bumped up. We got inventories came up a little bit in February, and that was a positive sign. But then inventories only rose 0.3% in March, while sales rose nearly 11%. So inventory to sales at the lowest point that I think in the total FRED database dating back to 1992, lowest point ever. Right now. So even if that reversion to services happen, the freight industry will be okay, simply because people will be restocking. We've got months, maybe even years of restocking to do. Okay. E-commerce acceleration. So obviously, while we were stuck at home last year, we started buying a lot more stuff online. We started buying a much wider array of stuff online. So furniture, big, bulky stuff. We also, and as a result of that, you have retailers trying to trying to please consumers with faster delivery times, and they're doing that through new fulfillment methods. So some of the best that you've seen this year, the great acronyms that have come from the pandemic: BOPIS, buy online, pick up in store, or BOPAC, buy online, pick up at curbside. So I'm sure some of you have tested out these services at Walmart or Target or wherever you shop over the last year. Those, Target has been trying to implement that since 2017, but it really hadn't gained any footing on that until the pandemic. But that is something that consumers have fallen in love with. It is an absolute amazing service. You order your stuff at Target in particular. They do this better than anyone. They have rewritten the book on e-commerce fulfillment. They are now fulfilling 95% of all orders from stores. More than 2/3 of online orders are fulfilled in store directly from there. You order online, you tell them when you want to come up, you pull up whenever you want, you call them, they're out in less than 5 minutes with your goods, contactless, you drive away. It's 15 minutes in and out. It's a fantastic experience. And that is just, we're finally, this pandemic has allowed companies to just hit the gas pedal on omni-channel, and it, kind of forced it upon consumers to use it. And I think some of these things are especially BOPIS, is something that will stick long-term. We can talk about why I don't think delivery or rapid delivery, has as much utility for consumers right now. We can get into that in the discussion later, but BOPIS and curbside pickup, those are incredible services that are here to stay, and they're going to be very meaningful.
Hey, Andrew, while you're there, Steve Lane has a question specific to Amazon and Walmart. Any insights into their logistics bottlenecks? And Steve, if you need to explain further, go ahead and jump in.
Yeah, so I'm a wholesaler to Walmart and Amazon. I work for, I have the license for Cuisinart. I do the grills and stuff like that, and we're seeing we can't get them to pick up. So I'm assuming it's the same ripple effect, only on their side, their logistics teams. While you have issues with collections when they can't pick up and you've shipped it, basically, that kind of thing. So it's a huge rippling through all the way through the order to cash cycle. So any insights into what they're doing?
That's a good question. I'll say you're exactly right about, people have coined it the bullwhip effect, where a demand flies up for a product, they sell out very quickly. They now try to put in massive orders, and it just creates this backlog. There's ripples throughout the supply chain. So that certainly happened. Particular to their bottlenecks, I don't. Maybe something will come to mind over the next few minutes, but I can speak about where they're growing, their plans for expansion, how they're trying to move product closer to consumers. But I don't really have. They are both unfortunately very tight-lipped about their supply chains and don't speak to me very much. But
fair enough. It's a pain point, and ultimately it's going to cause cash flow problems.
I can imagine.
Okay, and I do have some other questions, but I'll hold those until you finish here, but go ahead.
Okay. So you have the best in class retailers in particular are, they're trying to position product closer to consumers. Target has done this the best with just leveraging its stores. Back in 2017, they doubled down on what they thought was their only advantage over Amazon, and it was a great move. And that advantage was their stores. They've got, I can't remember off the top of my head how many thousands of stores they've got, but spread out all across the country, within 10 miles of 75% or 80% of the population. That is something that it will take Amazon a long time to get. They'll get there, trust me, but it will take them a long time to get there. So they've doubled down on that. That's how they've positioned product closer to stores. Walmart has done the same, leveraging stores as well, but now they are looking to automate as much of that fulfillment as they possibly can. Target has made plans for some automation, particularly in the back of their stores, but it's at a much slower pace than Walmart. Walmart's building at least 20 micro fulfillment centers this year, or in the first half of this year. These are about between 8,000 and 20,000 square foot, fully automated robotic fulfillment centers that will be built into a Walmart or onto an existing building. It's a great platform. If you haven't seen it, they're Alphabot Robotics. You should check it out. They've had great success in New Hampshire, I think, testing it. But so they're trying to position it closer there. You also have Ocado and Kroger, fully automated warehouses being built, outside of major metropolitan hubs, fully automated grocery, online delivery from there. You've got you've got Amazon building out. They're building out everything. They grew. Just to put this into perspective, the 2020 growth spurt for Amazon. When I say it's unprecedented, I mean that is like just the least use of the word. They have in the last 3 years added roughly 160 million square feet of warehouse space globally. That is what Walmart has built up in the last 50 years. Over the last 50 years, they've added that. That's what Walmart has currently. So Amazon's built that in the last 3 years, and they're not stopping. Their plans are even bigger and more ambitious, and they're now focusing on smaller warehouses and smaller delivery centers. They are the most recent plans that's getting me most excited is they're building kind of about 150,000 square foot, can hold maybe 100,000 SKUs of fast moving dry bulk grocery, and they're co-locating them next to bigger warehouses within about 45 minutes drive time of major metropolitan cities. This is their push for 2-hour delivery of groceries, of pretty much anything. That's what they're going to get to. That's what they're pushing for. Again, everybody's chasing Amazon, and Amazon is pushing faster and faster every day. And a big movement that we're seeing both from brands and from retailers is this movement to direct to consumer. So brands driven by the biggest brands in the world, Nike, Adidas, they and Under Armour, companies like this, they are cutting ties with some of their what they consider undifferentiated retail partners, a lot of the lower tiered sporting goods places and off-pricers, things like that. And they are going direct to consumer. So they're trying to either sell online, or they're in many cases expanding store count. Many of these companies are testing out smaller concept stores or building out bigger stores. All in general, they are building stores all over the place. That's one of my big takeaways from 2021 is we've actually have more retail store openings planned for store closures. I don't know if that will stay throughout the entire year, but right now we have more openings planned than closures. That's the first time in many years, maybe a couple decades that's happened. But you're also seeing it on the retailer side. So as some of those brands leave, and also Target wrote this playbook again, you are seeing companies try to have more and more private labels. You're seeing retailers try to have more and more private label sales. Target's now doing their private labels grew 37% in Q1. Just crazy growth, and they have great products. You're seeing Bed Bath & Beyond trying to do this. Walmart's doing it with apparel in particular. There's the best-in-class retailers are all looking to open up more private labels. And really, this is a great retail trend here. Is that there's never been the battle between retailer and brand. That's not new, but it's never been more intense than it is right now because both sides have so many options. It's never been cheaper and more and easier for brands to go and launch their own direct-to-consumer online channels through Shopify and ShipBob. I mean, a few $1,000s a month, and you can have you can leverage the Shopify network to have 2-day delivery. That's a viable option for many brands against Amazon or against other retailers online. And then also from the retailer side of point, you have space opening up in many areas. You have brands leaving you. You also have space opening up that is, you have very favorable leases right now if you wanted to open up smaller concept stores with direct to consumer brands. And you also have manufacturing capacity that has opened up in many places as these brands and retailers have cut down on SKUs to focus on high moving SKUs. So there's manufacturing capacity, especially in apparel, for brands that want to go that route.
Andrew, I've got a question along right in there. It's this is from Thomas and Rich and Libby. Don't worry, I will get to your question here in a second. But from Thomas Buckley, I assume that DTC, as it becomes larger, the cost for shipping will go up versus wholesale freight cost. Thomas, if you need to add any commentary, go ahead.
Yeah, I guess I was just trying to figure out a factor. I know that's the biggest thing we're struggling with. We're trying to jump on the DTC, but our freight costs are going through the roof.
Yeah, so I'm assuming freight costs as in, you're doing more parcels, less big
exactly bulk. Smaller instead of larger orders.
Right. Yeah, so it's also not the best time to be doing this, simply given the parcel surcharges right now. The parcel carriers have been rising costs for the last year or so. I think let me think about it. I mean, I guess, yeah, I think if you're going to do more parcels, until you get to a point at which you can reach some scale and you have good warehouse processes that can have things very highly sorted and batched to where you can you can leverage those parcel carriers to have better get some better rates from them. If you have that helps. But I think costs will rise incrementally. I think you'll have a higher transportation cost as a percentage of sale, but of course you'll have more margin there taking out the middleman.
And Thomas, to add, again, for me, I've got about 30 years of experience in the parcel industry. The bottom line is you've got FedEx, you've got UPS, DHL, plus the USPS as the major carriers. And the only other competition that's out there would be some of your local couriers. And then on top of that, you have some regional parcel delivery companies. The problem is they even themselves don't have enough capacity to handle all this volume. And of course, with that, prices have increased. You've probably seen it for the last 15 years. Prices continue to increase at probably at a minimum 3.5% per year, up to the high of, I think, 5.9% per year on the parcel carrier. So it's going to continue. And I think to your point, yeah, the cost of shipping will definitely increase exponentially higher than it would as wholesale freight.
Thank you.
Yeah, James, I think that's a good point, is that UPS, FedEx, they've done everything they can to keep up with this demand. They've added more service, they've added more capacity on the weekends, added routes, and they really did do a really good job towards the back end of the year. They kept up really well throughout the holidays. I remember I had oh man, his name is escaping me, for Satish Jindal from Ship Matrix. I'm not sure if any of you know him, but he helped launch Roadway RPS, the company that was eventually acquired and branded as FedEx Ground. So he's got 30 years of parcel experience as well. So I got some of the best data on parcels, and he spoke about how well they did on an on-time delivery rate towards the back of the year, higher than even historical averages. So yes, they did everything they could to add capacity and did a really good job, but had to raise rates to make it work.
Yeah, and a final point to that too is that's why, bottom line, Amazon is building out their own network, because they know, they're going to get rid of this $7 billion a year loss in freight, and part of that's going to come through them building out their own network. So
yeah, it is my belief that within the next maybe 5 years, Amazon will be delivering every single package that they ship. It will be quicker than you think it is. At one point last year, they were delivering 2/3. In June of last year, they were delivering 2/3 of all parcels. Amazon Logistics Network handled 50% of all shipments in 2020. So it's really not that far away, the rate that they are investing. So I think this is one of the big points in this UPS, in them eventually cutting off UPS. UPS is, after investing $4.4 billion in CapEx last year, is planning $4 billion this year, with the bulk of that $4 billion, according to Carol Tomé, the CEO, going towards not capital intensive expenditures, things like billing and actually on the technology side of things, where Amazon is investing $20 billion this year after investing $20 billion last year in its logistics network infrastructure alone. And they're going to do that again the year after, and they'll do it for as many years as it takes to build out that network where they can cover 98% of the country.
Andrew, maybe along that same line is a question from Libby. Who is making the money, the transportation or rail firms?
Both are making money right now. Carriers are doing very well. We're seeing carriers posting record quarters in the first quarter. We've got, if you look at their stocks, that tells the story as well. Many carriers, near all-time highs. The brokers in the same case. You look at Echo and XBO, JB Hunt. They all posted very strong quarters. Yeah, I mean, I would say both sides are making money right now.
Okay, go ahead.
And then the last point is, commodity price inflation. I will say this is not my area of expertise, but it's certainly something that's being talked about across the board. From consumers, you're seeing it starting to pop up in CPG for certain. That is where you saw it in the most recent inflation data from last year. Sorry, I have some number here. So the April CPI, it rose 0.8%, but a lot of that was driven by the used car market. I think 1/3 of that inflation was driven by used cars. We just had, the chip shortage and, high demand for cars. driven by government stimulus and driven by high savings rate. People are looking to upgrade. So used car market accounted for a lot of that growth. But we are seeing CPG inflation. That was where you, I think, 0.4% on groceries in April. But we're lapping last year's numbers coming up. So the numbers are going to be very wonky over the next several months. But from a commodity standpoint, lumber is obviously what everybody's talking about. It's crazy. You know, I don't have much to say. I've read some Wall Street Journal articles on why it is. They had a plant fire or something, and, you know, demand has been nuts as people renovate their homes, and housing starts have been very strong. So, you know, and that's tied to interest rates and housing starts, and interest rates are very low and housing starts are very high. So I think, you know, at least our lead economist, Anthony Smith, he spent a lot of time in lumber prior to coming to FreightWaves, and he didn't say this is fleeting, but he does expect this to moderate and to come back down to earth in the second half of the year. But that's pretty much all I have on lumber. So please, no questions on lumber. But across the board, you're seeing commodity. You know, I won't go through every number, but you're seeing commodity inflation across the board. You know, if you get into CPG, I mean, cotton prices are up 40% year over year. Everywhere you look, and it's trickling down eventually. But I think, you know, if you want to look at inflationary factors, in my mind, the two biggest places are here in commodities, which I'm not knowledgeable enough to have an opinion on, but the Wall Street Journal and other analysts say many of the markets are, you know, fleeting, that it is kind of pockets of demand where, you know, there's the inventories are very depleted and there's big restocking orders that again have that bullwhip effect throughout the supply chain and raise costs momentarily. I think that is the case in many of these commodities, but so this could be, you know, not as sticky as what the other inflationary pressures are, and that is in transportation. And there's very little of that wavering in the next 12 to 18 months.
Got it.
And then the last one, I just had to open it up for Q&A. So
Yeah, we have one more question. You know, how has port congestion contributed to the increased cost of maritime? And any thoughts on the availability of containers loosening up? And Rich, if you have to clarify that a little bit more, go ahead.
Yeah, well, if you don't need to clarify, very much so. The port congestion has led to a lot of that inflationary pressure on the ocean. As for container availability, you know, this is actually a theme that I wanted to say that has held across, you know, across both maritime and over the road transportation, is that in this recovery, we're walking a very tight line between supply and demand, because everything is so tight right now that any pull one way or the other, 2% increase in demand or a 2% decrease in capacity has a huge and lasting impact. And that is exactly what we saw in February when that polar vortex hit much of the country and froze much of the country. We were actually starting to see signs of routing guides fortifying. We were seeing contract rates being bid up, and we were seeing tender rejections coming down pretty steadily. It fell from, I think, 25 to like 21%. Then that polar vortex hits, takes 10% of the capacity offline, and, you know, the whole market goes back into haywire. And then we've been above 25% on the tender rejection and seen, you know, spot rate inflation since then, pressure on spot rates since then. We saw the same thing happen on the ocean side of things. We were seeing container availability finally start to, you know, come back a little bit on the China to the West Coast market. We were seeing the surcharges were actually, you know, coming down. We were actually seeing spot rates flattening, even coming down in some places. And then the Ever Given had to go and block up the world trade for a week. You know, again, this bullwhip effect, sending things into haywire. So I haven't seen in the most recent weeks, you know, in the last 2 or 3 weeks, but since that event, container availability has not been good. It has been getting worse. And, you know, given the strong demand that we're seeing and the expectations for record import levels, I wouldn't say that I don't think the container availability is going to get much better anytime quicker. I haven't seen the China production numbers. You know, they produce like 95% of the containers, and their, you know, iron prices are really high right now, which is kind of, which is bottlenecking supply over there. And I don't think all of their manufacturers have fully come back online. So I don't know exactly, you know, I would definitely, this is my perfect time to defer to FreightWaves. Greg Miller, our maritime writer, he knows this stuff inside out, and he writes 3-4 articles a week on container availability, on maritime shipping. I would definitely defer to him. He is the expert.
Rich, did that answer your question there, sir? All right. Does anybody else have any questions to ask If so, just go ahead and jump in there.
Andrew, thank you. It's Igor Vinarchuk. Thank you for a great presentation, great analysis. Do you see, like, looking in the future, do you see the structural shift to online, like not just for this period of time, but if you were to say, would you say that the adoption basically has accelerated and so we jumped forward, I don't know, 2, 3, 4, 5 years, or how would you characterize overall moving to the e-commerce kind of a side of things and whether the trend is here to stay? Thank you.
Yeah, great question. I think you really need to take it on a kind of segment by segment basis, or a product line vertical basis. Some of the areas where we've seen the biggest growth in e-commerce are areas where we're very reluctant to e-commerce to begin with. So grocery being one, that was something that Americans we just didn't buy many groceries online. Prior to the pandemic, I think you were looking at 3 to 5% of grocery spend was done online. Now we're looking at between 12 and 15%, and it's been steady since the beginning of the pandemic. So that is a structural shift, 3 to 4 times the grocery spend being done online. A lot of that, the majority of that is done through pickup services. So they're not being delivered, but they're still online sales. They're being picked up through store. The freight and the goods are still flowing through the store, but it is an online sale. Another one is, home improvement, building supplies, those types of things. Prior to the pandemic, you did not buy wood from Home Depot online, but now people are doing it. Well, regardless of the price, people are doing it online now, and they're buying big things, furniture, home improvement goods, things, all bigger and bulkier things. That is a structural shift. I think you've had two things. You've had consumers that have learned that it's okay to order things online. They've had that experience doing it, and two, you've had the best in class retailers, Wayfair, Home Depot, these people that sell big and bulky, they've gotten really smart about personalizing the shopping experience, making it easier to test things. I don't know if you've used the Home Depot app, but it's fantastic. You can test paints on your house. You can use AR fitting to see if the couch you want to buy fits into the corner of the room. It's fabulous. And these things just help customers have confidence and have conviction in their sales. And I think that structurally changes long term. And I do think we have accelerated, certainly. To say whether it was 2 years or 5 years, I'm not sure. I think, the easiest way to think about it, I saw that we grew about double the previous 5-year average of growth last year. So just the acceleration was about double the speed. I think that some of that will come back down to earth. The vast majority of sales are still done in stores. I think that's one takeaway that I've seen from this, watching so another shout out to a data source that you guys should check out is placer.ai. They've got the best foot traffic data. You can check it by store, by regional place, year over year, over 2 year, just amazing data, all free. Check it out. But one of the takeaways that I've seen reading their blog, watching their data on a weekly basis, is that behavior really hasn't changed over a really extended period of time. We are now seeing, where available, we are seeing behavior revert back to normal. As in, we're seeing grocery trips taken in the late afternoon and on the weekends, whereas during the middle of the holiday or during the middle of the pandemic, we were taking them all over the days, all over the time. We were doing much more online shopping. You're seeing the same things reversion back to malls. Mall traffic is now only down single digits compared to 2019. That's fabulous. But again, everything is just slowly going back to normal. So a very extended period of time. There have been some structural shifts, but I think the shifts have happened in segments that were just really slow to adopt e-commerce long term, or in the beginning rather.
Thank you.
All right. Anybody else? Mike? Vivian? Vivian, you're on mute.
Okay.
There you go.
Yeah, okay. I just have one comment. I did not like very much the e-commerce for home goods, especially the textiles. I needed to buy coverings for 2 couches that I had, and it took me a very, very, very long time to decide where to buy it from and which design to buy it from. And I looked at the weight. I had the close-up, the zoom of the textile, and I just didn't know where to go. And I tried several stores, and one store I tried, it happened to be a holiday, so they had a very good special, but I didn't buy right away. So the next day I went back on it to look at it. The price was almost double the next day. But in the end, I did end up buying from Amazon, and I have to tell you the truth. I'm not happy. When I go to a store, I feel it in my hand. I feel the weight of it. I feel the tightness of the texture. I feel the stretch of it. But online, how do you do all this? You know, they do show you the color. They do show you this. They give you the measurements. They give you the weight. But how do you conceptualize this, you know, in your home? And when you get it, you know, you're getting this package and you put it on and it looks okay, but it just doesn't feel right. Yeah, it just, I still like to go to a store and have a swatch and feel the material and see how it's going to look in my home. You know, it doesn't have to be a long time, but seeing it and feeling it is very different than looking at a picture that is very flat, you know. And that's my experience with the e-commerce.
Oh, I agree with you from a personal standpoint, and I would say that a lot of shoppers agree with you as well. That's one of the reasons that return rates are so high for e-commerce purchases, especially for heavy and bulky goods.
Yeah.
And I would agree. I think that is the reason that most people still venture in stores, and why people were so reluctant to buy furniture and buy big expensive items online prior to the pandemic. They were forced into doing it during the pandemic, and some liked it. That's all that, you know. I didn't mean to say that, you know, all of a sudden most people are going to be buying their furniture online. That's not the case. I just meant that people did become more comfortable buying heavier and bulkier goods online during the pandemic. And, you know, brands have done their best to try to make that experience as close to in-store as possible, but it's never going to be replicated until, you know, our phones can change shape and we can feel the texture. You know, we're a long way from that.
Hey, Andrew, we got one more question, and I want to make sure we get it in before we run out of time here. Any thoughts on the impact of the environmental legislation on the freight market, short term? Just one last question from Laura.
What legislation you're referring to?
Any thought as to the impact of environmental legislation on the freight market? Kind of short-term view.
Okay, I just didn't know if there was any particular legislation she was referring to, or just in general.
Laura, you want to comment?
Sorry, I had to unmute myself. Yeah, we do 50% of our business out in California, and there's a new regulation almost every day. And just curious, Andrew, I mean, I also have this thought that sooner or later we're going to wake up and realize that all this product that we're shipping as one-offs all over with all this packaging and everything else, what it's doing to our environment. And there's going to be a reversal, but that's probably longer term. My short term is, you know, with the new administration in the White House, you know, there's more of a focus on the environment. And is there any thought that there's going to be legislation coming down that's going to impact us?
I think I'd be speaking out of pocket if I gave any expectations on legislation. I mean, there's certainly lots of talk of it. I think, you know, Laura, I think looking at California is probably a good place to start if you want to know where the rest of the country will eventually go, or, you know, at least see where things will get tested. Half the time they end up getting propped out anyway for the freight industry and other industries anyway when California passes things. You know, I mean, I'll tell you one thing: we're seeing a lot of investments and a lot of partnerships in green energy, whether it be through hydrogen or through battery electric or hybrids. You know, it started last year with the Nikola thing. You know, everybody went crazy over that. But the truth of the matter is that there are a lot of companies doing a lot of great things in both battery electric and in hydrogen. And you know, it comes downstream when companies like Amazon and Target and Walmart, they set these 2030, 2040 carbon neutral pledges, that comes downstream. So they have to work with partners that are also carbon neutral and that you know, that try to work sustainably, and that just drives adoption of these technologies. So it's coming, it's happening very quickly.
Yeah, Laura, then the last thing I can add to, again, with my background on the parcel side, there are companies that are solely focused on what you would consider packaging optimization. So whether it's, better use of corrugated, either some type of a container that can be reused. As an example, growing up at UPS when I was younger, you ripped open the envelope and you disposed of it. Nowadays, when you rip open that envelope, it has another now seal where you can then kind of reverse it and then reseal and then reuse that envelope again. And companies like Amazon are requiring vendors, Walmart are requiring vendors to come up with basically reusable packaging. So it's coming. And I think, Andrew, you're right. The way California goes, everybody else goes and follows. So I'd say you're probably going to learn it before we do, Laura.
One thing I'll add to that, Laura, if you want to check out a really cool company that is focused on that problem, is solving the packaging problem. It's a company called Olive. You can check them out, olive.com. It was started by, his name is escaping me, but he is one of the co-founders of jet.com and diapers.com that got acquired by Walmart. He spent 4 or 5 years in the Walmart supply chain, but he left Walmart, and his first venture after he's left is this company called Olive that has partnered with several hundred, maybe 1,000. They're starting with apparel companies. And what happens is, you basically download this Chrome API, this Chrome plugin to your computer, and you shop online as you normally would. But when you go to checkout and you click ship, rather than it getting shipped to you, free 2-day or, whatever the shipping may be, it sends it to an Olive warehouse, and all of your packages that are bought from all of the places that you buy are sent there, and they are put in a reusable tote that is delivered once per week, and all of your package come in one time. So they're trying to eliminate not only the packaging, they're not eliminating the packaging, but they're reducing much of the packaging, and they are trying to reduce the number of last mile stops that are needed. And you can also send returns the same way through that box, very simply and freely. So check out Olive. I think it's a really good idea. And I think companies will continue to try to find ways to incentivize sustainability. I think that is something you'll see from a lot of retailers, whether it be just showing the hidden costs of transporting things fast, or one of my favorite ways that I've seen is the apparel company Timberland. They just ran this test where they offered to plant a tree in your name if you took a slower delivery time. And 14% of people took the slower delivery time just for them to plant a tree in your name. So I think they're going to continue to do these, they're going to get really creative at the ways to do this. Amazon has an offering, I think they call it 1 day, where all of your packages that you buy from Amazon, they all just come on 1 day. Not many people use the service, but it's there, so they're going to continue trying to do things to do that.
Great, thank
All
you.
right. One last question. Rich, you want to go ahead and you're on mute.
Myself. Let me unmute myself first. Yeah, we are a shipper, and we're in the direct mail industry. So we use both full truckload and LTL, and are interested in connecting with either MBE or MWBE certified freight forwarders and people in the freight industry, because we would like to expand our relationships with those certified firms. So I'm seeking anyone who either is or is aware of those kinds of firms that would be interested in engaging a dialogue with us. So I'm not sure how best to do that, but I can put up an email address if you want to do that.
Yeah, I definitely would do that.
Okay.
Drop it in the chat, and
I'll do that right now in the chat.
we'll grab it.
Thank you.
All right, Andrew, awesome. That's all I can say. Just this wealth of knowledge. I told Mike when you and I had our conversation, a bright young mind, and I mean that in a very positive way. We thank you for all of your research, your diligence, and sharing, the information you do on FreightWaves. And like I said before, if you guys aren't following that company, you better start following them. 1, 2. What I can tell you after talking to Andrew and listening to him today, I'm going to definitely make sure I follow him for sure. So
That's a great point. That's really a great point, Jim. Andrew, this was very insightful, great discussion. I would just encourage everybody to sign up for Point of Sale, the newsletter, and follow Andrew on on FreightWaves as well.
Yeah,
Jim.
I'll throw the link if anybody would like to sign up into the chat, and I'll have I'm sorry, I'm forgetting her name, but I'll have the lady that joined us early.
yeah, Joyce. Yeah,
Joyce.
Yeah.
Yes, Joyce Gibney. I'll have her send it out with the recording.
You got it.
Great.
All right. Well, again, we drop it in there and we thank you and just appreciate all of your time and the energy you put into this presentation. Okay.
Cool.
Excellent job.
Yes, no problem. Thank you so much for the opportunity.